Hi, this is Tom Painter, and this is the three steps. Hi, this is Tom Painter, and this is the 3 steps to financial freedom. We're going to concentrate on which investment accounts that you're going to use. Now, when you go to the bank and open up a checking account or a savings account, you're actually loaning money to the bank. When you go to Fidelity or Schwab or a company like that, you can open up a brokerage account where you can open up accounts to buy stock and bonds and things like that. And we're going to discover the different investment accounts that they have available to you. Now, there are 3 steps to becoming financially independent. Number 1, you have to invest in yourself first. 2, you need to decrease your expenses. And number 3 is you need to increase your income and your net worth. So step number 1 is to invest in yourself first. We've talked about what are your dreams, what's on your bucket list, your why. You need a why in order to go out there and make things happen. And then we need to set up your financial freedom accounts. We're also going to talk about where are you now, where are you going to be, and some what ifs to figure out where you're going to be in the future. So step 2, of course, is to decrease your expenses. And to do that, every dollar that comes into your life is either saved and invested or spent and consumed. You need to decrease your cash outflow without changing your lifestyle. And where does it all go? We need to find systems to be able to track our money and how much are you paying in taxes. Step 3, of course, is to increase your income and net worth. And to do that, we've talked about your income from a job, investments, small businesses, and real estate, of course. So invest in yourself first. Now, in this example, Jane Doe is 25 years of age. She's investing for the next 40 years. She starts with 0, and she's going to invest about $250 a month and receives a 10% rate of return. And in this example, she's just going to put that money into an investment account. You can see in the first column it's $250 a month. She has no company that's helping her. There's no tax benefits. She's going to do it for 40 years at a pretty aggressive rate of return. And we're using this one because it's kind of easy to figure out. The value on that, she's going to have that stock is going to appreciate, but she's going to have to pay an awful lot of money in taxes. And in this case, with state and federal taxes, we're saying she's going to have to pay about $400,000 in taxes after she retires. So her net retirement is going to be about $938,000. Now, the good news is you have $1 million. The bad news is $1 million won't be worth very much in 40 years from now. So would you like to get a tax deduction this year? You open up an individual retirement account. So when you contribute to an IRA, you get a tax deduction today and you pay less taxes. So this is how it works. Let's say that you have a salary of $100,000, and that's what you're going to report to the IRS. Now, if you open up an IRA and you contribute to your IRA, we're going to take $3,000 off of that. Let's say that's the amount of your contribution. And you have what we call adjusted gross income down to $97,000. Your salary is $100,000, but we get a deduction of that $3,000. That brings our adjusted gross down to $97,000. Now, the benefit is that you can deduct that amount from your IRA in taxes this year. You get a little bit of a tax break. The challenge is that when you retire, you have to pay taxes when you withdraw the money. And we don't really want to do that. So there's the same $250 going in there. And you can see that it's quite similar to what the other one is. You're probably in a little bit different tax bracket, but you're basically going to have about $1 million or so with that. Now, there's a better way to do that, and it's called a Roth IRA. And because our real goal is to have a big chunk of money when we retire and not have to pay taxes on it. So in order to do that, we're going to open up what we call a Roth IRA. And let me show you how that works. Here's the same $100,000 salary. You're going to report you made $100,000 to the IRS. You're not going to take a deduction today. You don't get a tax break today, but you get a tax break on all the money that's in that account. You're going to get it on the money you put in plus how much it's gone up in value. So it's the real goal, again, of course, is to have a big chunk of money, but to have that money where we don't have to pay taxes on it. So if we take that same example here, here's $250 a month going in there. The big difference is that you don't have to pay any taxes on that when you pull it out of retirement. You didn't get a tax break today, but I don't care about today. I care about the future, because not only is the money I put in there, but all the money that it earns is going to be tax-free. So that's why we'd rather do a Roth IRA. Now, the fourth one is if you're working at a company and they have a 401k match, what that means is that in many companies, you can contribute some percentage. In this example, we're going to use 3% of your income into your 401k. Now, for every dollar that you put in there up to a certain level, then your company will match 100% of that, 50% of it, 20% of it. Just depends on what your company is doing. So here's what that looks like. You reported $100,000 in retirement income, but you donated, I shouldn't say donated, you contributed $3,000 to your 401k. And so on your tax return, your adjusted gross income shows that you're at $97,000. Now the company matched that of $3,000. They got a tax break for that as well. And so as far as the IRS is concerned, you reported an adjusted gross of $97,000. You're getting a tax break today. The big benefit of that is that the company matched it. Now there's not very many companies that are doing this, so you've got to ask some real interesting questions. The benefit is that you can deduct that amount. The bad part about it is that we're going to have to pay taxes on all of it. The biggest plus, though, is that your company is matching a portion of it. So in this example, you're going to have a lot more money in there. Now, how do you get the money to be able to do that? Some people say, I just don't have enough money out of my paycheck. And the real question we have is, when you file your tax return, do you get a big tax refund? If you're getting a big tax refund, you're probably not adjusting your withholding correctly. If you're getting a big refund, you're probably loaning money to the government. So we can adjust your W-4 so that it will change the amount that's deducted. So you have that extra little bit of money to live on. But the real key here is to get that match. And in this example, let's say we're going to use that same $250, but the company's matching that $250. And it grows for the same amount. And you'll see that you'll have a lot more money because we put so much more money into it. You're going to pay a bunch of it in taxes, but you will still have a lot more money after it's done. So what we recommend people do is that if you are working for a company that has a 401k match, match up to whatever they're doing. If they're doing 2% or they're doing 3% of your salary and they're matching 100% of that, get that 100% match. That's great. But on top of that, anything else on top of that, we recommend you put it into a Roth IRA, because we don't want to have to pay taxes on all that gain 30, 40 years from now. Now, of course, that's assuming that you have the discipline to do that. But if not, have them just pull it right out of your checking account and forget about it. But what we like to do is have that money taken out of your checking account, put into your 401k, and have a certain amount pulled out of your checking account and put into your Roth IRA. So that's the different investment accounts that you have. This is Tom Painter talking about the 3 steps to financial freedom and the different investment accounts that you can use.